All right, now we're going to talk about notes payable. So notes payable are usually similar to an account payable in that we owe money, but it's more formalized. So the note payable is going to involve a written contract, which is going to include the amount borrowed, the repayment date, and the annual interest. Because interest is involved, we need to use our interest formula we've learned back in Chapter 4 in order to calculate that interest. And the interest formula is the principal, which represents the loan amount, the amount borrowed, times the annual interest rate. Interest rates are presented on an annual basis. So we're going to multiply the principal or loan amount times that annual interest rate, and then we're going to multiply it by the number of months the loan is outstanding, meaning how long we borrowed the money, divided by 12, and don't mess with my 12. There's 12 months in a year. It doesn't matter if it's a 3-month loan, a 6-month loan, an 8-month loan. When we're doing our calculation, we divide by 12 because there's 12 months in a year, and the interest rate is presented annually. Students screw this up all the time. It says, oh, it's a 6-month loan, and people try to mess with my 12 and put a 6 there. Don't do it. Okay, you figure out how many months it's been outstanding. So if we borrowed the money on October 1st, and then the year end is December 31st, October, November, December would be 3 months outstanding. We still divide it by 12, whether it's a 6-month loan or a 9-month loan or a 10-year loan, because there's 12 months in the year. Don't mess with the 12. So here's an example of a note payable. We borrow the money on November 1. December 31 is the end of the fiscal year. And then we have to pay interest. It looks like on April 30th, and then the interest and principal is due on October 31st. Interest is an expense incurred when a company borrows money. The only thing that needs to be done in order for a company to use interest would be for time to pass. And because of the matching principle, we have to include the interest in the period in which it is used, time passing, whether or not we've paid the money to the bank or not. So let's go through an example. Assume on November 1, a company with a December 31 fiscal year and borrows $100,000. The annual interest rate is 12%. Interest is payable on April 30th and October 31st of the following year. The principal is payable on the maturity date of October 31st. So on November 1, how do we record this? Well, remember, all of this is A equals L plus C, revenue minus expense equals net income. At this point in the game, the book doesn't really spend a lot of time with the accounting equation. It just dives right into the journal entry. But I want you to remember, we're still thinking in terms of ups and downs. So if we borrowed $100,000, cash, an asset, is going to go up $100,000, and then our liability, note payable, is going to go up $100,000 on November 1st. So our journal entry is going to do just that: debit cash to make it go up, and credit note payable to make it go up. At this point, there's no interest because time hasn't passed. We just borrowed the money. Now, by the end of the fiscal year, December 31, the company's incurred 2 months worth of interest. Why 2 months? Use your fingers. November, December, that's 2 fingers that have went by. So then, using the calculation in the formula, $100,000, the principal amount times the interest rate of 12% times 2/12 gives me $2,000. So what happens to our accounting equation now that we've used this interest? Well, because we've used it, we're going to have $2,000 go up in expense, which makes net income go down and equity go down. We haven't paid it yet, so our interest payable liability is going to go up. To make that happen in a journal entry form, we're going to debit the expense and credit the payable. Then again, this is old news. We've done this back in Chapter 4. On April 30th, the company has incurred an additional 4 months worth of interest, and now we're going to pay it. So what's going to happen now is we need to use our formula to figure out the interest. So it would be the principal amount, which is $100,000, times the interest rate, which is 12%. times the number of months outstanding, which is now 4 out of 12, and that's going to get us interest for this new period of $4,000. So what happens is we have an expense going up 4, which makes net income go down 4, and equity go down 4. And then because we're paying it, what's going to happen is we're going to pay 6 in cash, the 4 from the current period and 2 from the previous period, and our interest payable is going to go down by the 2 from the previous period. So we're going to pay off the amount we owed at December 31, which is $2,000, and then we're going to pay off the additional $4,000 in interest. So here they're showing you that they're breaking it up into 2 pieces. So first they're recording the interest expense and the additional interest payable. In practice, you really wouldn't do that because you don't record a payable and then pay it on the same day. They're doing this to kind of simplify it. They're showing you, okay, well, we're going to have $4,000 in new interest, and then that's going to create an additional $4,000 payable. Then they're going to pay the entire payable off. But if you look at these 2 entries, we have our interest expense, which is what I said we'd have, the $4,000. The interest payable, the net effect to that, if we have a 4 credit and a 6 debit, is a decrease in the payable of $2,000, which is what I have up here. So when I did it in my accounting equation, I showed the net effect. So liability go up 4 and down 6, so the net effect is -2. So you can separate it into 2 separate entries like this, or you could do 1 entry. The entry I would have done, and sorry I don't have much space for it, is I would have debited interest expense for 4. I would have debited interest payable for 2, and then I would have credited cash for the entire 6 that's being paid. So I would have done it all in 1 entry. You can do it in 2 and get to the same place. Whatever makes the most sense to you is fine. What isn't shown on here is the entry for the payoff of the loan. So when we pay off the loan, which would be on October 31st, which I'll try to write up at the top, we're going to have another $6,000 in interest, which would be the $100,000 loan. No, maybe it's not 6,000. Hold on. Yeah, October 31st. So on October 31st, remember we paid interest through April 30th. So what's after April? May, June, July, August, September, October. So that is 6 months. So we're going to multiply the loan times 12% times 6 out of 12. That gets us another $6,000 in interest. So then our entry is going to be to debit interest expense, $6,000. And then we're going to debit the note payable by 100 because we're going to pay off both the interest and the loan amount. And then we're going to credit cash for the 106. So though it's not shown on the slide, I thought it would be useful to add it on here. When we pay off the loan, we're going to have another 6 months worth of interest, so we have to record that expense. So when we debit the expense, that makes the expense go up. We're going to pay off the loan amount, so our liability goes down, and then our assets go down by the 106, which covers both the interest and the principal amount. To provide accurate information about how much the long-term debt is due in the current year, the company reclassifies its long-term debt as current within a year of its maturity. So as an example, if a company borrowed $5 million at the end of December, half of the loan has to be repaid January of 2020, and the other half is due January of 2021. The 2019 balance sheet would report the following. So at the end of 2019, half of the amount is due within the next year in 2020, and then half of it is due beyond a year in 2021. So even though we have a long-term loan, half of it is due within the next year as of the end of 2019. So that's going to be shown as current. The other half would be shown as long-term. Together, they comprise the entire $5 million loan. So this is like what I had mentioned earlier. If I have a car loan, the amount that I have to pay within the next 12 months would be current, and the remainder amount that I owed would be treated as long-term. Next type of liability we're going to talk about is contingent liabilities. The word contingent means it's dependent upon the outcome of some future event. So the most common type of contingent liability would be a lawsuit. So as an example, think of Starbucks. Somebody falls in Starbucks. There's a slip and fall. That occurs in 2018. The company may have a contingent liability if a lawsuit is filed, and the amount of the liability would be contingent upon the outcome of the lawsuit. GAAP has certain rules in place to determine how to deal with contingent liabilities. First, you have to determine if you can estimate the amount or not. And then you have to figure out the probability that you lose the lawsuit. So the only time you actually record a liability is when it's probable that you're going to lose and you can estimate the amount. That's the only time you record a liability. If the chance of losing is remote, the other extreme, then you do nothing. So whether you can estimate it or not, you don't have to do anything if the probability of losing is remote. So the way I kind of learn this chart is I think of the extremes. When it's probable I'm going to lose and I can estimate the amount of the liability, I record a liability. If the probability of losing is remote, then chances are it's not going to happen, so I don't have to do anything. And then any other situation, if it's probable I'm going to lose, but I don't know the amount, I would just disclose it. Or if we fall in the middle with reasonably possible I'm going to lose, then I disclose it as well, whether I can estimate it or not. Now you might ask yourself, why do these rules exist? Well, the best example I can give you is an example I had in the real world with one of my clients. They had a liability they were going to lose. They did something really terrible and they knew they were losing. So they were under the probable situation. And they said to us being myself and other people at the firm I worked at, we were the auditors, they said, well, we should record 100,000 because we know it's not zero, so we might as well record 100. And they really had no clue how much it would be. It couldn't be estimated. So we said, no. You fall in this disclose in the footnote category. According to GAAP, we should just disclose it, not record a liability. And they said, no, we should record 100,000 because it's being conservative. It's better than zero. And we said, no, you have no clue how much it is. You have to just disclose. Well, we won the argument because we were the auditor. They just disclosed it. And what that does is it allows the user to determine how much it might be. Well, it's settled. And if we were in the class, I'd ask you how much do you think it's settled for. We'd go around the room and you'd all yell out numbers. So it'd be like, 100,000, 200,000, $1 million, and so on. And then I would let anticipation build, and I would tell you that the lawsuit settled for $30 million. Yes, they did something very terrible, and I can't tell you what because of confidentiality. However, the bottom line is, if we had allowed them to put 100,000 on the books, most users would have said, well, it says it's an estimate, so it might not be accurate at 100, but I don't think anybody is going to say, oh, 100,000, that could be about 30 million. They're going to think maybe 150, maybe 50, maybe 200 if the shit really hits the fan. Nobody's thinking 30 million. So that's why it's important to only disclose the liability potential if you have no clue how much it would be. And then you let the user use their imagination and come up to an amount. If we put the 100,000 on the books, then the user is going to think, well, if it's probably going to be about 100,000. So ultimately what that does is it gives them a false sense of security. Even though we say it's an estimate, they expect that you have some clue when you're putting a number on the financial statements. And in our example, we had no clue, so no number was the right choice. So that's why these rules exist. You need to memorize them. It's easy if you just think of terms of the extremes. So the only time we record a liability for a lawsuit or contingent liability is when the chance of losing is probable and we can estimate the amount. We do nothing when the chance of losing is remote. In any other scenario, we simply disclose it in the footnotes.